One of the most common questions I get from LPs is, what does a great operator actually look like?
So it took me 4,576 phone calls to get the first deal. People, for example, ask me, would I ever invest in California? And be like, heck no. Well, my philosophy is live where you love to live and then invest where the returns are the best.
Everything from the LP perspective, what should they be thinking about when they're evaluating an operator and they're starting to understand the niche that operator plays in?
A lot of people were going out, buying a property, painting the unit, and then bumping the rent $200 and calling it value add.
Today's guest is Andrew Cushman. Andrew is the founder of Vantage Point Acquisitions, a firm focused on acquiring, repositioning, and operating B- to A-class multifamily properties throughout the Southeast. Since 2011, he's been investing in markets like Florida, Georgia, and Texas, where he's successfully syndicated and repositioned close to over 2,900 units. I'm excited to have him here. So welcome, Andrew.
Glad to be here, Pascal. Good to talk to you again.
Hell yeah. So, Andrew, I would just, for everyone who's listening, I gave a little bit of an intro to you, but I wanted to start out with maybe a little bit of your story so that people understand how you started as, maybe a chemical engineer to getting to the point where you're flipping multifamily homes. And then we can dive into strategy and market takes and all that kind of stuff.
Yeah, so like you said, I took the standard path into real estate and got an engineering degree. I actually knew I didn't want to be an engineer. When I was in high school, I knew I wanted to be an entrepreneur, but I had no idea how to do that or what that would look like. So I figured if I got an engineering degree, I would always have a decent income and a job opportunity until I figured out my real calling. So yeah, graduated, worked for a big food company as an engineer. A few years after starting work, got married. My wife had the same mentality I did. So we tried a million different little businesses, and every one of them were like, oh, okay, this is making a little money, but this is just going to be like an even tougher job than we currently have. So like, nope, nope, nope. And then in 2006, we discovered or came across the idea of flipping houses, and we live in Southern California. And we're like, oh, this looks interesting. And we dove into that. And in 2007, we did our first deal. Now, I was an engineer who wasn't good at being on the phone. And at the time, the hottest thing or the best avenue to flipping houses was, or at least what we picked, was calling people who are in pre-foreclosure and trying to help them solve it, knowing that 1 out of 100 were just going to end up having to sell at the last minute. So as an engineer who didn't really like talking to people and wasn't good on the phone, I went into a business that relied solely on my ability to cold call strangers and say, hi, you don't know me, but let's talk about your financial problems. So it took me 4,576 phone calls to get the first deal, which was in 2007. But we purchased a condo from a guy, fixed it up, resold it, made as much money on that condo as I made all year long at my engineering job. And we said, all right, there's no better sign than that. I'm out of here. So gave my boss like 2 months warning, said, hey, I'll wrap things up for you, leave you in a good spot, but I'm done. And left to flip houses full time right as the market started to collapse. We actually looked at it as an opportunity because, like, well, geez, there's going to be a lot of foreclosures and everyone's going to be scared of real estate, so we won't have any competition. It was a good thing we saved the money from that first flip because it took 6 months to get to the next one. But eventually we got it down, did it full time for 4 years. And then by the time we got to like 2009 and 10, we had some great years, but everyone else was starting to figure it out too. And the competition was going up, the margins were going down. And, there's some very skilled flippers out there nowadays who've built incredible systematized businesses out of it. That wasn't us. It was my wife, myself, a couple of cats, and an admin assistant, and we were doing everything. And it was brutal. It was a lot of work. And so we said, well, man, like, what can we do that will create, lasting income and build wealth? And then at the same time, we were sitting there in 2010 going, okay, like, what's the next big thing? And so our reasoning was like, all right, we just had a huge recession. So after a huge recession, typically you get a long expansion. Long expansion means job creation, rising incomes, all those kind of things. But everybody and their mother just got foreclosed on and can't buy a house for the next 5 to 7 years, or they know somebody who just got foreclosed on and they're going to be scared to buy a house for the next 5 to 7 years. So what does that mean? Okay, rentals are going to do really, really well. And so at the time I had a coach for flipping, I said, "Hey, do you know anybody we could learn apartments from? We think that's going to be the next thing that should, have a boom." He's like, "Actually, I do." And he connected us with a guy who'd done 800 units. We hired him to teach us the business. We worked with him for a year. He kind of held our hand through the first deal, which almost killed us trying to get that thing closed by the skin of our teeth, but we did. And it's been a great business ever since. I guess 14 years now, just under 3,000 units. And, despite the ups and downs, never lost, investor money in a syndication. We've got some deals that aren't quite exceeding pro forma, but every single property in our portfolio is cash flowing and making distributions. We don't have any distress. We don't have any debt issues. And we're looking forward to the next cycle that I think we're getting ready to start. So
I love it. I love it. So, for all of those who are listening, multifamily real estate is a very large niche. So, could you hone in and give us the way you think about the niche that you play in within multifamily?
yeah, that's a really good point. It is a pretty large sector, and we've honed in on a business model that works for us. And people, for example, ask me, would I ever invest in California? And be like, heck no. But there's lots of people who've made millions, if not billions, of dollars investing in California. It doesn't mean you can't do it. It's just a different business model. So, and that's candidly one of the keys to success is narrowing down what you want to be good at. And so for us, that is, I would say, upper workforce housing, meaning, class, you said B minus to A minus. So people who have a little bit of leeway in their monthly budget. We do lose some people to buying houses, but then the other half are probably renters for life. But it's not class C or lower where if they get a flat tire, they can't make rent. So it's a little bit of a blend of renters by choice and renters not by choice. Again, that big middle of the market that serves the greatest number of people. We like the Southeast U.S. And for us, we define that as North Florida, Georgia, Carolinas, Eastern Tennessee, and select submarkets of Alabama. There's other great markets out there, but one mistake that I see people make is just chasing deals that are all over the country. And they don't have it's inefficient. It's difficult to run teams. So we want to stay contiguous. And we look for properties that are between 80 and 250 units that are built between 1990 and 2010. That's the sweet spot, but we'll go to 1980 or all the way up to brand new construction. And we're generally looking for some kind of value add, and that can be a blend of management value add, which is actually the highest return on your effort, and or physical value add, which is probably what most listeners are familiar with. If I'm going to go in and redo the kitchens, etc. So that's been our niche, and it continues to be, and it's treated us really well.
All right, we're going to get back to the episode here in just a minute, but I'm going to take a pause here and talk directly to you. If you are a retail accredited investor in commercial real estate and you are seeing fewer than 10 deals every month, you are not investing, you are gambling. You are having a blind spot. And if you're gambling with your money, sooner or later, you are going to lose. The pros don't play blind. Institutions will look at hundreds, sometimes thousands of deals before investing in the top 1 or 2%. And that is why they keep winning while most individuals are left with average returns at best or devastating losses at worst. Now, I'm an LP investor just like you, and I had to solve this problem for myself. And today, I now get flooded with hundreds of deals every single month. And using that deal flow, I've now invested over $3.3 million across 23 deals. And now those investments generate my family over $100,000 a year in passive income. Now, here is why that is relevant to you. I've packaged all of that deal flow into a free starter kit so that you don't need to play blind anymore. Inside, you'll get at least 25 current opportunities that are updated every Friday, plus some education about the exact system I use to filter out the losers and zero in on the winners. The best investors don't win by working harder. They win because they see the deals that no one else does. And this starter kit puts you on that side of the table. And you can claim your free copy at passiveinvestingstarterkit.com. and start seeing the deals that the pros are seeing. Again, that is passiveinvestingstarterkit.com. And with that, let's dive back into the show. So I would love for anyone just listening to, I mean, as I'm listening, I'm taking a step back and I'm taking note about how crystal clear Andrew is on his buy box. And I think as an investor or an LP who's looking and evaluating different GPs or operators in the market who you're going to invest with, I mean, it's going to be hard not to keep saying like, oh, Andrew this, Andrew that. But, I do think I want to highlight excellence. And I think that is a good start. And I'd love for you to go one layer deeper on a couple of these. I want to spend some time here because I think this is actually where a lot of the gold is and where we can really understand how you as an operator thinks. So I would love to let's dissect a couple of these. I'm gonna maybe make a list and then we go through them sequentially one by one. But something that stuck out to me was management efficiency was one. You said between 80 and 200 units. You also talked about maybe the demographic of the type of individual. So all of these, there's a very specific reason that you've chosen those, and I'm sure they may or may not have evolved over time. But let's start with maybe the middle one. I'd love to understand, how did you arrive to 80 to 200 units?
Basically, it comes down to efficiency and managing from afar. So, as I mentioned or indicated earlier, I live in Southern California, not far from Disneyland. And people ask me all the time, "Oh, you could live anywhere. Why do you live in California?" And I say, "Well, first of all, that's where my house is, and then second of all, my philosophy is live where you love to live and then invest where the returns are the best. So I can go surfing and snow skiing on the same day in Southern California, but then go invest in Georgia and have very stable, solid returns." And the reason that we started with 80 units on up is because once you get to about 80 units, that is the size property where you can economically afford to hire a full-time on-site manager and a full-time on-site maintenance person. So if you've got at minimum two dedicated employees whose sole job is to manage the day to day of that asset, and then of course they report to us, and our job is to serve them and make their jobs as easy and effective as possible, so that then they can run those assets and serve those residents as effectively as possible. So that's why our cutoff is 80 units. And the reason that there's a soft cutoff at like 230 or 240 is because we found that once you start getting into the 300s, the biggest one we've ever bought was 350. It changes. It's more like running a small city, or if you're trying to reposition something, it's like turning the Titanic, because you've got this massive property, all these people. It's a slightly different animal. Again, not that you can't make money with them. It's just we found the really big ones are just don't prefer. And so that's why that size range. Now, there are exceptions to that, and I'll give you a great example, because I mean, if someone's listening going, well, that's great, Andrew, I'm not going to run out and buy 80 units for my first or second or third deal. What you can also do is pick a market and buy 20 units, and then a mile away 6 months later buy another 20 units, and then 6 months, and you can quickly in a small area get up to that 80 or 100, and then you can create that for yourself over time. So if you can't go right out to 80 80 units, you don't have to. And by the way, my first property was 92 units, but we paid 7,500 a unit for it. So it wasn't like, from the get-go, we were like going out and buying $15 million deals. So that is why. Now, also, if we own, I mean, we've got multiple examples of this. If we own 100 units and a mile down the street, a 40 unit property comes up that checks every other box except it's small, we'll buy that and then just tack it onto the other one, because we can still run it far more effectively than almost anyone else because we have those teams. So there's multiple ways to do it, but the initial, the mindset to have is, whatever you're buying, how can you run it as efficiently and effectively as possible, especially if you're not living near the asset.
So as an LP who's maybe listening to this show particularly, you know, uh, what what are the concerns that the LP should have in terms of maybe working with an operator who does sub 80 units or more than the 250 units, right? Like you have this specific niche, you have a certain business model. From what it sounds like is that you have control of your own staff, whereas maybe if you're doing sub 80 units, that those people are generally hiring an outsourced management company and don't have as much control over the operations, or like those might be a pro or a con. Can you everything from the LP perspective, what should they be thinking about when they're evaluating an operator, and they're starting to understand the niche that operator plays in?
Yeah, you're right, because it changes as you move from, let's say, a 40 unit to 140 to a 340. And candidly, any group that's buying 340 units, I would hope they've got pretty well established relationships and operating systems and all that. My greater concerns would be at the level below that. And we actually we use a hybrid property management system. So technically, we do have a third party property management company. We've partnered with them since the very first deal. So we've been working with them for almost a decade and a half now. And they take care of all the headaches of day-to-day management, right? Like the lady in 4C, her dog bit the guy in 4B, and we got to file with these evictions and collect the rent, and there's a leak in the bathtub in this unit. They handle all of that. However, where a lot of operators get into trouble is, even with the best third-party management company, they buy a property, hand it over, and say, "All right, cool, send me the report at the end of the month." That does not work, especially in today's market, which is far more challenging than 5 years ago.
How can an LP understand if that's happening?
So, it's just a matter of digging, right? So, for example, well, here, how about you want to just role play it quick? So, all right, Pascal, I'm looking at your deal here. It's 50 units, looks pretty good. How are you going to do property management on that?
We're gonna outsource with this property manager we've used on all of our other deals.
All right, so they manage other properties for you in these same markets.
Yeah, yeah.
Okay, so how do you manage them?
I meet with them every 2 weeks, and they give us a report, and we're in constant communication.
Okay. Well, and I don't want to, I don't want to take up the whole podcast, but you can see where I'm going is I would keep drilling. Well, what do those meetings look like? Who's on them? How are you holding them accountable? What kind of reporting? How often does someone from your team show up on site, both announced and unannounced? Right. If you go to the property, let's say I'm the LP, right? So if I go to the property, Pascal, and I ask your property manager, "Hey, who do you work for?" What are they going to say? If you go to our properties and say, "Hey, who do you work for?" They're going to, "Oh yeah, Andrew and Kelly," and they're not going to say that they work for the property management company because they're so in tune with us. And so those are the kind of questions you just want to keep, just follow the trail down. Oh, we use third party. Oh, great. What's your relationship with them? How do they specialize? What you don't want is, well, yeah, they're going to send us a report, and we'll do calls, and they also manage self storage, and they also manage, they have a marina, and all this. That you want to make sure that whoever's doing the third party, that is what they specialize in. For example, the company that we use, they specialize in C plus to A minus properties. They generally don't do luxury, and they don't do Class D where you got to bring a gun to collect rent. So yeah, those are some of the questions that I would start going down the path to figure that out.
Yeah, and these questions are kind of universal, regardless of how many units the operator is investing in.
Yep.
Yeah. You mentioned another one, which, I think when most people think about a value add strategy, they think of the general, let's change the paint color, let's upgrade the unit. And there's actually this second type of value add, which you've mentioned is much more efficient. Can you dive into that?
Yeah, it's funny. Value add kind of got a bad name the last few years of this most recent cycle, because a lot of people were going out and buying a property, like painting the unit, and then bumping the rent $200 and calling it value add. That's just turning a unit in a booming market. That's not value add. Value add it's in the name. It's increasing the value of the asset where it stands today. If the market's going up and the rising tide lifts all boats, great, that helps. But that's not value add. That's the market going up. And so there's a lot of different ways to do value add. We don't get into conversions or making an office building into an apartment complex, or again, not that you can't do that. It's just complicated, and we decide to try to keep things simple. So for us, when we look back over the last 14 years or so, the two main types of value add that we have focused on and continue to focus on are light to moderate physical value add. So we're buying a property right now, and it'll be closed by the time this comes out, but it was built in the mid 90s, hasn't been updated since. Now, it's 95% occupied, it's cash flowing, it's stable, it's not a big mess. However, the exteriors need to be repainted. There's mildew on the siding. The kitchen countertops are, let's see, almost 30 years old now at this point. The cabinets need to be redone. The flooring needs to be redone. So we're going to spend, I think it's about 17,000 a unit on the interiors. We're not moving walls or doing anything crazy, but we're going to significantly enhance the quality of the units, and based on where the market sits today, significantly bump up the rents. There's a property right next door that is basically is kind of like already there, and their rents are far higher. So it's proven out today. So even if the market doesn't go up, we should be able to significantly increase the NOI by doing those renovations. That is a physical value add. And again, you can do lighter versions, you can do heavier versions. But my favorite value add is actually management value add. And, and this actually tends to get easier to find the smaller you go. Many operators who can afford to acquire 100 200 unit properties are at least somewhat decent at management. Surprisingly, not all of them, but a lot of them are. But as you move down, you know 40 units, 20, whatever, that you tend to get more and more of maybe owner operators who haven't kept up with the market with their rents. And they the people, there's a certain subset of owners who don't want to rock the boat, or they want to keep things easy. So they know if they don't raise rents, nobody will leave, nobody will call them for anything, and it's just easy. And that's to some degree true. So when you find the properties where the rents just haven't kept up with market, even today in 2025, with rents down somewhat, those properties still exist where they didn't keep up with the huge rent increases we had for the several years prior. And that's probably the easiest. But then also, we find properties, again, and exists all the way from 20 to 200 plus, where they don't have a website. They aren't marketing on TikTok and Facebook Marketplace. They don't have good screening processes in place. So their delinquency is high, and they have constant turnover because they let people in to who don't qualify, and 6 months later they stop paying rent. So just kind of implementing best practices in management is really the easiest value add, because you generally don't have to spend any money at all to do it, or very little. So that's our favorite lowest risk, highest return on effort value add is management. Second to that is the physical value add that I described earlier. And if you can combine those two, you're generally in a really good spot.
And you mentioned a third piece of demographics, and there's a certain demographic that you like to play within. Can you talk to us about why?
So the most important thing when it comes to demographics, when you're evaluating either your own deal or a deal that a sponsor has brought you, is, can the people that they are trying to serve in the market afford the product? So if you looked at, there's various definitions of affordability, but generally speaking, in the United States as a whole, obviously not in places like California or New York, but as a whole, if a person can spend 25 to 30% of their gross income on housing costs, then that is affordable. So what does that mean for the apartment investor? Well, if your target rent is $1,200 a month, then what is you want to make sure that property is in an area where the median household income is at least 48,000. Right. So if someone's making 4,000, actually that's slightly off. Let's just say round it, call it 1,000 a month. So that means they're paying 12,000 a year. So you want that to be in an area where the median income is 48,000. So only 25% of the median income goes to rent. That means you will have a deep and reliable pool of people that you can serve with your product, and they'll be happy and very able to pay for it. So that's number one, is making sure that this income. And then the biggest thing is you want to be in an area of population growth. The number one determining factor of your success is going to be demand and supply. If you got more people coming in than there is housing availability, you're probably going to be in good shape. And if those people can afford your product, you do those two things right, that'll cover over a bunch of other potential mistakes pretty well.
Many of if you're an LP looking at a lot of these deals, you don't have a lot of time to redo the entire due diligence that the operator did. So do you have any kind of shorthand recommendations that an LP can do when they're looking at a deck and it says there's 3% population growth, or what, how could an LP do a quick fact check on these types of stats?
The good news is that's getting easier and easier, meaning you can just go to Claude.ai or Perplexity.ai or any of these things and just search it. So, for example, I don't know, let's say someone brings you a deal in Katy, Texas, and they're saying, hey, we've got this population goal. And you just get on, let's just say Perplexity, and say, what has the population growth in Katy, Texas been for the last 4 years? What is the projected population growth for the next 5 years? And just fact check it that way, and then do some of the calculations yourself. Say, look at the investment summary and say, well, all right, well, what rents are they targeting? Okay, it's $2,000 a month. Well, what's the median income? It's 45,000. Okay, wait, that's going to be a problem. And if they don't have that information, that is a red or maybe yellow flag in the first place, if they're not saying, providing all of that stuff. And then, in terms of a shortcut, candidly, it really all comes down to the operator. A great operator can take a so-so deal and turn it around and make it decent, but a bad operator can take the best deal in the world and run it into the ground. And if someone, if you're looking for a shortcut and you're just getting started with an operator, then just don't do it. You need to spend the time up front to dig in. But once you really get to know an operator and you've done 3, 4, 5, 6, 7 deals with the same person, and you know how they work and how they underwrite and how they operate and how they communicate, that's when maybe you don't need to, ask the same questions over and over and over again. Because again, it really comes down to the operator far more than the deal. But up front, it sounds trite, but it's just like Google it. Use AI, go out and verify it. Yeah.
So something, easy step here, right? Like, what is the average median income of the area, and then what are the target rents, and then there's a benchmark there, right? Like you said, for you want to have less than 25% of the rent. The rent needs to be 25% of the average median income or less, right? So in your case, that's like a benchmark we just said. Let's talk about, those numbers are going to be all across the board. Maybe if you're in San Francisco, it's 50%. I don't know. What do you think are those? What's maybe a benchmark where if an LP is looking at a deal, they're like, oh, I listened to this episode and I'm going to do a quick fact check and just look at what their new post renovation asking rents are, and what the median income is, and it comes out to be 30% or 35%. At what percentage should there be a flag going off in the LP investor's mind?
Well, you alluded to it. It really depends on the market. I mean, housing out here in California, I think it on average takes like 60% of income or something like that. I mean, I honestly don't know how most people do it given those numbers. What I would say is the higher that percentage gets, the more concerned I would be. And then another thing is I would compare it to what's normal for the market. if you're looking at a property, and let's say in California, and you do the calculations and it takes 40% of gross income to cover the rent, that's actually amazingly good. But if I'm looking at one and it takes 40% in rural South Carolina, maybe not so much, because most of the other product is going to be more affordable than that. So that's kind of the other second piece of it, is you've got absolute affordability, which is the percentages that we're talking about, but then you've got relative affordability. If your property takes 40% of income, but every other asset around takes 25 to 35, you're going to have a problem. But if you take that same thing and say 40% and move it to Orange County, California, and everything else takes 60, you're probably in a really good spot. So you've got the absolute aspect and you've got the relative aspect.
Diving a lot into the details,
And also, I want to circle back to one other thing about verifying, essentially fact checking sponsored data. You're very unlikely to get the exact same data, because even as a sponsor, I can tell you that's one of the things that is challenging. Is, let's just say, you can take population growth, rent growth, any of those things. If you pull up four different sources, you're going to get four slightly different numbers. And so you have to try to figure out, well, which one seems the most reasonable. If you're talking about rent growth, I'd go with the lowest one to be safe. So, if you're looking at an investment summary from somebody and they're saying the population growth for the last 5 years was 1.8% annually, and you as my 10-year-old says, you search it up and you find out 1.7, oh, these guys are lying. No, it's the data. It depends on who's reporting it, where it's coming from. There's nuances to it. But what you're looking for is that they say, oh, population growth is 1%, and you pull it up and it's like they left off the negative. It's actually going down. That's not good, right? So you're checking for within a range, not exact perfect matches.
One thing I'd like to dig into kind of before we get into market takes, because I do think there is quite a bit happening recently that I'd love to get your take on. You've spoken about quite a bit on LinkedIn, but uh, you know, I was fortunate enough that Andrew took me on as a real estate coaching client several years ago, and in that process, he shared all of his documentation with me about how he goes about finding deals and what his process looks like. And I think first and foremost, Andrew, I don't know if you have or allow LPs to see it, but I think one thing that really stood out to me is the first off that Andrew had an SOP for how he screens and finds deals. And I think that is, when you're in the due diligence process, that is something that is actually a huge positive signal for me, which is that one, there is a standardized process in place and you can go through it. And I found oftentimes when I talk to an operator, they won't go into the amount of detail that I would hope that they would. And as I've played in this game longer and invested with different operators, I've invested with 23 different operators at this point, that it's drastic. And so I want to take a second and dive into some of the detail that I noticed, and then maybe Andrew can expound on it. But short of showing you a screen sharing, if you're listening in your car, difficult to follow along, but the thought process here is the process was maybe an 8-page document that went through everything from first, we're going to look at where this property sits on a Google map. Then one of the next steps is we're going to take the little human on Google Maps and we're going to place him on the street and we're going to look around as if we're there. What does it look like? What is the property next to? Is it near a shopping center or other apartment complexes, or is it near a main road, or is it and literally on the sheet it says like, do the surrounding neighborhoods and buildings have new roofs, or are they all dilapidated? Is the area well kept or is it not? There's a whole section around the crime report. I think there's 2 different sources that he uses in order to look up crime. Are there Are there roofs nights? How do the roads look? Is there a nearby university? Because those things can skew the median income. Can you talk a little bit more about kind of this SOP process to finding deals?
At the high level, the purpose of screening is to identify which deals are not worth spending your time on and which ones are. Because you want to leave yourself as much time as possible to really dig into the deals that have high potential and not waste your time underwriting ones that are never going to work. That's why we literally call it our screening process. And Pascal, I mean, you outlined a good chunk of it. So the first thing is um, Google Maps. Like, you're just trying to get a sense of the area, and it's amazing what you can gather from just looking at a satellite view. Like, well, how, yeah, the other neighbors clean kept? Is You can tell, like, is the landscaping nice, or is it all dead? Is do the buildings look like crap, or is there a convenience store right next door with a gas station? That might be a problem in some areas. And yes, and we do that with the satellite view. We do that with the street view. Take the little yellow Google man, drop him into the neighborhood, like you said, and see if he gets robbed. If he gets robbed, you don't want to go there. So that's number one. And then the next thing we're looking for is I already talked about the median income. So there's a lot of different sources to get that. We pay for ESRI ARCGIS, so it's ESRI ARCGIS. It's only $100 a year, and it's got all kinds of really good granular data overlays. And so after we kind of get a sense of the neighborhood, does this look like the kind of neighborhood we want to own in? We go look at the median income. We then also look at population growth. So we will not buy in a property we will not buy a property in an area that has negative population growth, because if that continues, doesn't matter what kind of value add you do, your rents are going down. And ideally, we want to be in an area that is growing population wise at a rate faster than the US as a whole. Because if population growth were to slow, or you get into a recession, the tide starts going out, the further above average you are, things can come down and you can still be moving forward, if that makes sense, right? So, national growth is, I think, 0.67 a year the last time I saw the statistics. So ideally, we're in an area that's like 1.2, 1.3 or higher. So we do a number of different sources to check for population growth. We also go to FEMA.gov and verify that the property is not in a flood zone. We will not buy a property in a flood zone. Now, if the corner of one building is, maybe touches one, maybe it kind of depends on the circumstances, but we won't buy in flood zones. That's a business decision, because we don't want our residents to have to go through that. We don't want to have to go through that. It dramatically increases your insurance costs, and your competitor a quarter mile down the street who's not in a flood zone doesn't have to pay for that flood insurance. He doesn't have that expense, and residents aren't going to pay you higher rent because you have to pay for flood insurance. So it's a competitive disadvantage. And that means, all things being equal, your NOI is going to be lower than the property down the street. Therefore, your value is going to be lower, especially when you go to exit. So we do not buy in flood zones, and the flood insurance market's, pretty. I don't want to say sketchy, but it's in turmoil these days. There's a lot of risk there if you open yourself up to that. You mentioned, we also check crime maps. That one's actually a little bit tricky, because I think there's about 87,000 different sources now where you can get various crime maps and all that. And again, this is just a screening process, so you're just trying to get a sense, like, is there a lot of crime or is there not? And then, actually, probably even more important than that is the type of crime. If you're in an area where there's like a Walmart and a Costco and a Home Depot, and you're tucked in kind of behind those stores, it's going to show as high crime, because there's tons of people going in and out of there, and there's going to be car break-ins and petty theft and all that kind of stuff. That's not necessarily a red flag. That's just because you have high population density. What you want to avoid is any kind of violent crime. So assault and battery, shootings, homicides, arson, anything like that. Because number one, again, if you're in an area, you can clean up the property, but you can't clean up the neighborhood. And if you're in a neighborhood with that kind of stuff happening, you're not going to get good residents. And even worse, you're not going to get good team members. You're not going to be able to get the good people to come manage those properties for you, because they don't want to come to work in those kind of areas, in those kind of neighborhoods. And then on top of that, you're going to have a lot more trouble getting insurance. There's areas south of Atlanta where getting insurance is extremely difficult. And if you do, they're going to exclude violent crime, which means if there's a shooting on your property and somebody sues you, the insurance carriers be like, oh, sorry, that's your problem. We excluded it, right? And Canada, we don't want to deal with that. We don't want to have that risk. And then even you might have problems getting loans if you're in high crime. So there's all kinds of reasons to stay out of the high crime areas. I mentioned flood. Something else that we check is cell phone service. Nobody will stay in an apartment complex that has crappy cell phone service. We live on these devices now. We stream video. So if again, if we're actually doing real due diligence, we're going to go there and check for real. But we just go. You can go to the carriers, and there's cell phone density. I forget the exact term for it, but basically there's maps that show the strength of signal in an area. And so when we're screening, we want to see an apartment complex that's in an area with strong cell phone signals. And then just simple Googling. So if I'm buying, Creekside Apartments in Macon, Georgia, which actually I wouldn't buy in Macon these days, but I would search, Creekside Apartments, Macon shooting, Creekside Apartments, Macon flood. Look for anything that got that apartment complex in the news, because there's almost no good reasons for an apartment complex to be in the news. You want to find out. We narrowly missed what would have been a disaster by doing that on a property in North Carolina years ago. The seller, it wasn't in a flood zone per the map. The seller, but when we got there, like, okay, this is clearly flooded based on the renovations you're doing. What happened? Oh no, it's just one-time thing. Blah 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 blah. Well, we found out what had happened is the city had redone the freeway and they blocked a culvert, and they didn't, when they rebuilt it, they made it way too small. So like on a regular basis, the property would flood, and I mean talking 6 to 8 feet of water in the units. So we backed out. Somebody else bought it, and we saw it on the news a few weeks later. There were groups out there picketing to have the place shut down because no one should live there because of the flood hazard, right? So these are the kind of things you're looking for. Like we Googled and like, wait, this property's been in the news not once but like 3 times. Like for flooding, we're out of here. It doesn't show on the flood maps. And then also you're checking the Google reviews. This you can take with a grain of salt, because sometimes the really good reviews were, let's just say, incentivized to be put up, but also the really bad reviews are often the people who decided to not pay rent and they're getting evicted, and so they're going to go put a bad review. But you're looking for trends. So if people, if you've got a 5-star review that says the manager's great, and then a 1-star review that says the manager's mean, and they don't fix things or whatever, take those with a grain of salt. But if you see 10 reviews and 4 of them mention break-ins or they heard shootings or something like that, those are red flags. So sometimes bad reviews can be things to run away from. Sometimes bad reviews can be opportunities, and same thing with good reviews. So that's kind of the short, high level steps that we go through with anything before we even think of underwriting it.
So there are 2 things I want you as a listener to take away from this. The first is, I don't know, I like to think that I want to work with an operator who is more sophisticated, who is thinking through these items, that has a strategy, that has a reason. Oh, I'm doing this because of X, Y, and Z, or this is part of my plan, or, versus like, oh, this is just in my backyard, we just invest here. It is a common response that I get, right? So, everyone has their own flavor or style or type of person that they like to invest with. But I like to invest with someone who has some thought behind it. And I hope that this nerdy discussion, this rant that Andrew just went on, kind of highlights what that type of thinking is that I would expect from an operator. The second thing that I would like you to take away is look, Andrew just rattled off all the different things that you could do, or that at least his firm does, to screen out and initially evaluate properties. One, we have as LP should have a similar process. Maybe it's not as granular at the property level, but for us, it's like, what types of deals are they doing? Do they have a strategy that I like investing in, developments versus value add, or in a certain geography, or whatnot. But also for us to take away the due diligence spectrum. Now, as an LP, there's the whole spectrum of, hey, I'm investing in this deal because my friend is, and I think that's good enough. And then there's the other end of the spectrum where you've been following an operator for a couple of years. You've looked at every one of their deals. You've talked to them on the phone 10 times. You've had an analyst rewrite their pro forma, and you're analyzing there's the two spectrums. And there are tidbits that you can take away that Andrew mentioned, that you can very easily, within 5 minutes, just do a quick double check on all of the items that an operator is telling you. Hey, I can quickly go look up a crime map. I can quickly, look this up on a Google map, take that little yellow man, stick him on the map, look around and see, what does this area look like? And I think it's important for, you to figure out what are the steps that you're taking, and what are you double checking along that process as you're vetting an operator. Do you have any comments to that?
I mean, I think you laid it out pretty well. I guess I would say, like, the things that I just went through before I stepped down from my screening soapbox is something that, none of these things are out of reach for an LP to double check. These are all resources. Now, Esri, okay, that's paid $100 a year, but if you're going to be making multiple LP investments on a continuing basis, it might be worth $100 a year. Or find someone who has it and ask for a screenshot, or ask a broker friend, like, hey, could you send me a report, maybe a CoStar report or something like that on these markets? So, most of this stuff is easily accessible to anyone who's as investing as an LP. And so, yeah, I'd go through and take the time to double check it. Again, if it's your eighth time with a sponsor, maybe you don't have to spend as much time. But the first time around, definitely would. And then, Pascal, you mentioned another really good thing that's I is worth noting, of getting on a sponsor's list and hanging around for a year. And just, what is the communication like? How's their current stuff going? What kind of feedback are you getting? What's being talked about in forums? All that kind of stuff. So.
Love it. I'd love to take a transition here and talk a little bit, maybe I wouldn't say it's gossip, but market trends. There are some interesting posts. If you don't follow Andrew on LinkedIn, I highly recommend it. He's a wealth of knowledge and has an interesting take. One of the couple topics I want to get to here, but the first thing I would like to dive into is this concept of operators or sponsors raising what they're calling preferred equity rounds. So I'd love for you to kind of highlight what that dynamic is, and then your take on that as an LP who's maybe seeing these deals, and trying to evaluate, is this a deal that I should do or not?
Oh man, there's so much about this one topic. So I'll mention a few things that come to mind, and then feel free to take it in any direction from there. So yeah, the trend nowadays of raising or getting preferred equity at 15%, which seems to be the magic number, is definitely one of my pet peeves. And for anyone who's not familiar with what that means, preferred equity, it's literally what it's called, right? Meaning that this new equity is preferred or takes higher priority in the capital stack than all of the rest of the equity. And so what we've seen happen, especially the last couple of years, is a lot of sponsors and groups have a lot of properties that are in trouble for a variety of reasons. Either they have negative cash flows, the valuations are down, they can't refinance, they got floating rate bridge loans that are coming due this year, etc. And those properties require a capital call. However, the industry has kind of adopted the stance of, like, well, hey, if I just go out and raise a preferred equity fund and announce it, and I've literally seen emails like, we are excited to announce, our preferred equity fund 15%, and not tell people that the reason they're raising this fund is to take the money and put it back into their own deals to keep them going for a couple more years. The problem with that is, number one, if a property can't meet its current obligations, and then you stick a big chunk of equity on top of it that requires a 15% return, how is that property going to ever pay that off? If you hold it for another 7 years, maybe, but it's not very likely. Also, again, that preferred equity goes on top of the loan in front of the original LPs. So those original LPs, you're probably never getting your money back, because not only is the value already come down, there was probably no equity there left. Now you've stuck another big chunk in front of it. And if so, that there's all, and again, the biggest problem is a lot of these things are coming out and they're not disclosing what they're using it for. I've seen many of them advertised as, hey, we're going to go out and we're going to place this pref equity and we're going to earn you 15%. And then in reality, what we see actually happen is they're putting it into their own deals so that they can say, number one, they've never done a capital call, and number two, to avoid foreclosure. So that's kind of the worst of it. And then it goes all the way down to, does it actually solve the problem? And there are cases where pref equity can make sense and is a good thing, and there's a whole spectrum in between. So where it does make sense is, like, let's say you're an LP in an investment, and the operator comes to you and like, hey, we have a loan that's coming due, and obviously everyone knows where the market is, and in order to refinance out of this loan, we need, let's just say they raised $10 million. We need an extra 1.5 million to pay down the balance of the loan. But if we do that, we can refinance into a 5-year fixed rate Freddie Mac loan, and basically it eliminates the risk. So your leverage goes down, your interest rates go down, and then after that refinance, the property cash flows again. Would I participate in that pref equity? Yes, I would, because it actually solves the problem and the sponsor is being transparent about what it's being used for. So that's kind of the gamut. And then, if I'm an LP in a property where the sponsor goes out and gets third party preferred equity, which they're often charging 15, 16, 17%. And by the way, there's typically clauses in those deals that allows that preferred equity provider to come in and take over the deal if they don't like what's going on, or if it doesn't meet certain hurdles. And guess what happens if the preferred equity group takes over the deal? Everybody's out except for them. The sponsors are getting nothing and the original LPs are getting nothing. So it's not that pref equity is wholly a bad thing. It's just that it's getting misused and abused, and kind of misrepresented in many cases. And the baseline thing, again, if you're an LP, the two main things to understand is, number one, does this pref equity solve the problem or just kick the can down the road? Is it extend and pretend, or is it truly fixing the issue? And then uh, the second piece is to understand that preferred equity basically functions as additional debt. So it's levering the property up, because that is paid off before you get paid off as an LP. So those are the two key things to understand.
So if you're an LP, there are a bunch of these deals coming around, and I mean, different sponsors have different reasons for doing them. I've seen a couple legit ones where they're forthright about why they're doing it and everything like that. And so I think so many of the people who've talked to me about these deals, the question keeps coming up is like, it sounds, if you're getting when do you find an investment that gives you a 15% preferred return? And a preferred return does not mean it is guaranteed, but the thesis is that you are getting paid first when the property sells. And so, besides the loan, you're in the first to be paid out. And so, what are questions we should be asking ourselves or the GPs who are raising the money for those types of deals? As a new LP, you don't really care, if the other LP holders are holding the bag. That's part of the game. They made that investment, right? We're looking at this new investment today. What concerns should we have? What questions should we be asking?
So the first one would be, what does the total capital stack look like? So if you take the debt, whatever loans exist, and you add on the preferred equity, what is that total? And then what is today's appraised value of the asset? So if you've got a $10 million loan and then you're adding 2 million in preferred equity to it, and today's appraised value of the property is 15 million, you're probably okay, at least in the sense of getting your capital back. Cash
Because
flow
you have
that's
60% loan to value of the building and there's enough money of the equity to be pulled out.
right. But what we're seeing a lot of today, not every, again, there are plenty of operators who are using pref equity appropriately and have a business plan, and it should solve the problem. Unfortunately, a lot aren't. The other side, the flip side of that is let's say you've got a $10 million loan and they're saying, hey, we're putting 2 million in pref equity on it, but the as is current appraisal of the property is 10. You've effectively over levered that property. And the only way you're getting your money back, even as the preferred equity investor, is if the market does go up and they increase the value of the property. Now, I do believe by the time you get to 27, 28, and 29, values will be a lot higher. But would I bet on that as my only path to getting my money back? Absolutely not. So that's kind of the first thing is the value of the asset versus the total amount of capital. And then of course, if you're looking to be an LP, you're even on you're on top of that, so the total gets higher. The second thing is, how is that return going to get paid? And this goes for all kinds of stuff, but if the sponsor is raising preferred equity and then taking some of that and using it to pay the preferred return, that's essentially a Ponzi scheme, right? You're raising extra capital to turn around and give it back to the investors and then call it a return on capital. Now that's not saying like if you got a property that's making distributions and you hit a rough spot, you might pull a little out of reserves to keep the distributions going. That's a business decision. That's, to me, that would be okay. But if you know that you're creating an investment that can't sustain the returns that you're telling people, and in order to quote unquote fix that, you just raise extra money to then hand back to people, that's an issue. I've seen that happening a lot. So that's one of the things I want to find out is, what exactly is the sources and uses for this money? What is it going to? I saw one recently where the operator had made loans to some of the properties that they have in order to keep them going. Now they're raising preferred equity at, again, a very high rate. I do have to give them credit for at least being transparent. One of the uses of that money is to pay off the loan so they can get their money out of the deal. So you could take that one of two ways. You could say, well, they're getting themselves liquid again, so they're able to help a deal if need be, or are they just getting all their money out so when it goes bad, they don't get hurt too? I don't know the answer to that. So those are the things that you got to look for. Like, where's the money going? And then, kind of coming down the down the spectrum a little bit to, let's just say, you know, operators that are being transparent, that do have a good plan, how are these returns going to be paid? I see some where it's like 15%. Others are, like, hey, you're going to get 5% now and 10% catch up at the end. Okay, that's probably more realistic. There's very few properties out there right now who are in the position of, hey, this property can't pay the mortgage, but all of a sudden we're going to put 15% preferred equity on it and it's going to be able to pay that out. Like, that math doesn't quite work. But if a sponsor is saying, hey, we're going to get this preferred equity and you're only going to get 5% now, but you're going to get caught up at 10% at the end, that sounds like it's probably more realistically underwritten and thought out than the former scenario. And again, not every one of these things is bad. There are cases where preferred equity actually probably is the best solution, but you've got to dig into, does it solve the problem? What's the total equity in debt versus the valuation, and what are the source and uses of the cash and the cash flow, and make sure those three things all add up properly in determining whether or not you're going to participate in that.
All right, Andrew, that was you dived into a lot here. You dove incredibly deep. Anything from, why you chose to pick out your niche in multifamily investing, what your process looks like, and even just helping us understand some different market trends. Thank you so much for joining us today. Where can people follow you online, learn more about you, maybe get on your investor list?
So I'm not a social media guy. You're not going to find me dancing on TikTok or posting things to Instagram. As you mentioned, the only social media I'm on is LinkedIn. I do post there usually a couple times a week. That is actually me posting, and it's not AI or an assistant. And if you comment and I reply, that is me actually replying. So yeah, follow me on LinkedIn or connect there. And then our website, if you just Google Vantage Point Acquisitions, it usually is the top several hits, but just vpacq.com. And there's a couple of different tabs on there. Learn about us, connect with us, whatever you're looking to do. So those are the best ways.
All right. Thank you so much again, Andrew. For those of you listening, if you're ready to dive deeper into passive investing and grow your portfolio, you would love to continue listening to this every Thursday on the Passive Income Playbook here on the Best Ever CRE Show. If you enjoyed this episode, please subscribe, leave us a 5-star review. Your feedback helps us continue to provide valuable content and find amazing guests like Andrew to help educate you. Thanks for tuning in, and I'll see you next week for another episode of the Passive Income Playbook.